You bought an investment property. Maybe a unit on the coast, maybe a parcel of shares, maybe an exchange-traded fund you barely think about. And somewhere in the back of your mind sat a quiet little promise. Own it long enough, and when the day comes to sell, the tax office only ever touches half your gain. That promise is gone. And here is the part that has not sunk in yet. It is not a proposal. It is not a maybe. It is already law. The old deal worked like this. You put money into something, a rental, some shares, whatever it is, and you own it for at least 12 months. When you sell, you add up your gain, and the government lets you knock 50% straight off the top before you pay a cent of tax. Half your profit, tax-free. That is the famous 50% capital gains tax discount, and for more than 2 decades, it has quietly shaped how this entire country invests. From the 1st of July 2027, that flips. Instead of halving your gain, the tax office takes your original purchase price and lifts it up in line with inflation. You only pay tax on what is left over, the real gain, the part that is not just prices drifting upward. And there is a floor sitting underneath it. A minimum tax of 30% on that gain, no matter how low your income happens to be in the year you sell. Your own home is still exempt. The roof over your head is left completely alone. But almost everything else outside your super is now in the net. Investment properties, shares, that exchange-traded fund, even crypto. And to be clear, this is not a rumor, and it is not a plan for one day. The tax office has already listed it as law. To really see the difference, picture the same gain under both systems. Say you paid $600,000 for a rental, and years later, it sells for $900,000. That is a $300,000 gain. Under the old rule, you halve it, and you are taxed on $150,000. Under the new rule, if prices rose 25% across those years, your purchase price is lifted to $750,000. So you are taxed on the $150,000 that is left. Same answer. But if inflation had run hotter, say 40%, your purchase price lifts to $840,000, and now you are taxed on just $60,000. Same property, a very different bill. So where does that leave you, specifically? If the only property you own is the home you live in, you can breathe out. Nothing here touches it. If you own an established rental, the new rules bite on any growth after July 2027. If you own shares, an exchange-traded fund, or crypto outside your super, it is the same story. The growth after that date sits under the new system. Brand new builds are the one exception. They still get the choice of whichever system leaves the owner better off. And if your investments sit inside super, you are outside all of this, for now. Now for the twist that makes this whole thing almost funny. This brand new system is not new at all. It is the old one. Between 1985 and 1999, this is exactly how Australia taxed capital gains. You adjusted the purchase price for inflation and taxed the rest. Then in 1999, the Howard government scrapped it and brought in the 50% discount we have lived with ever since. And here is what does not make the poster. That discount was not really a gift in the first place. Lifting the price for inflation, or just knocking off a flat half, those are two rough ways of doing the very same job. Both are trying to make sure you are not taxed on price rises that were not real gains to begin with. For years, people have called the 50% discount a handout to the rich. It was really a blunt stand-in for the inflation maths we are now going straight back to. So why did they switch in the first place? Part of it was simplicity. But as plenty of tax commentators have pointed out, it also landed at the exact moment the government needed to win the public over on a much bigger, much more unpopular idea, the GST. A clean, simple tax break makes a very good sweetener. So we spent 26 years calling an inflation adjustment a discount. And now, very quietly, we are walking the whole thing back. And here is the sting in the tail. Going back to inflation is not automatically worse for you. If inflation runs hot and you hang on for a long time, the new system can actually tax you less than the old 50% ever did. It genuinely cuts both ways. So follow the money. Who actually benefits from the 50% discount as it stands today? Overwhelmingly, the people who already own the most. The wealthiest fifth of Australians collect almost 90% of the benefit of that discount. The top 10% take more than 80% of it. So when the government frames scrapping it as fairness, as helping first home buyers, as cooling a red-hot housing market, that is the story, and there is real weight behind it. But here is the quiet part. Look closely at who got left out of the change. Your super fund keeps its own lighter treatment. It was safe from the start. Brand new builds and the big build-to-rent projects are carved out completely. So the tax system is quietly steering money away from an ordinary person buying an existing home and toward the property developers and the funds instead. And this is what they don't tell you. Because super keeps its softer deal, and because foreign investors sit under a different set of rules again, this change can actually leave a large super fund or an overseas buyer better off than you, an ordinary Australian just trying to build something outside of super. The people it squeezes hardest are not the billionaires. They are the sparkies and the nurses with one rental and a modest parcel of shares. And there is one more quiet detail buried in the fine print. For 40 years, anything acquired before capital gains tax even began, before September 1985, was completely untouchable. That blanket exemption is being wound back too. Some of the oldest assets in the country are being pulled into the net for the very first time. So what does this actually mean for you? If you own an investment right now and you sell it after July 2027, your gain gets split in two. Everything it grew before that date is still judged under the old 50% rules. Everything after is under the new inflation system, which is exactly why some investors are quietly getting their properties and shares valued as at that date. So the line between the two is clean and settled. And that is the one genuinely useful thing to take from all of this. The date is fixed. Your records are not. The purchase contracts, the receipts for each renovation, a solid valuation as at that July. Those are the pieces that decide your bill, and they are far easier to gather now than to reconstruct in a panic years later. None of that is something to guess at, and it is not something a video should decide for you. The one big shelter that has not moved is the family home. And past that, the honest answer is that whether the new system leaves you better off or worse off depends on your own inflation, your own timeline, and your own numbers. That is not a question a video can answer for you. That is a sit-down with a registered tax agent question. Because the real lesson here was not really about tax. For 26 years, we all argued about whether these rules would ever actually change. And while the whole country was busy arguing about if, the rules quietly changed to when. It is already done. The only question left is whether you understood it before it mattered or after.